Hey, welcome back, everybody, to today's Market Explained, a four-star media experience. Brian Castle, your host, here with Mr. Christopher Reardon. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon, everyone, and glad to be here. Glad to talk a little bit about these crazy markets and what's going on out there.
And Chris is our Director of Development at FourStar. He runs the portfolios, all the products, all the recruiting, all the efforts at building that happen here at FourStar. So, and he's experienced, runs our portfolio team. So, a lot to say about that. So, and he loves his Cleveland Guardians, they call them, right? Not the Indians anymore.
Cleveland
Uh,
Guardians now,
al-
although a lot of people like to still call them the
Although
Indians.
I saw Indian shirts all day in Cleveland last weekend, so the people
Still
still
there.
call him the Indians. Anyway, he's a Clevelander. Welcome, Chris, to the show. And I am Brian Castle, your host. I'm the CEO and founder of FourStar Wealth Advisors, Chief Investment Officer. I'm also a advisor to insiders of companies and a financial advisor as well. And I'm the father to Quinn and Evan and husband to the amazing Tripty. If you guys would hop on Apple iTunes and give us a 5 out of 5 ranking, that'll help our numbers as we do the show. And so we're going to start talking a little bit about the markets. Chris, what do you see out there? Tell us what the relationships between the different markets are right now.
Yeah. So looking at the asset classes, some of the trends we've seen in the past kind of continuing to a degree. So we still have international equities holding that number one position. It has 285 tally points, and it actually gained 8 points since our last podcast. So
Uh,
continuing to strengthen, albeit pretty slowly. Domestic equities is in the number two position still, and it's at 276, and it gained 7 points since the last podcast. So both those two asset classes are by far the number one and two as far as tally scores go. And number three, we have a bit of a drop off. It's commodities, and it's at 213 tally points, and it was actually minus 14 from the last podcast. So a bit of a drop off there. The bottom three, cash is still holding steady in the fourth position. It's at 125 tally points and unchanged.
mhm.
Currencies is in the fifth position. It's at 100 tally points, and that's minus two. And fixed income is in the sixth and last position still. It's at 86 tally points, and it gained 1 point since the last podcast. So not a
Mhm.
whole lot of change. I mean, what we're really still seeing as far as movement is really those top three asset classes. We haven't really
Mhm.
seen a lot of movement from those bottom three in quite a while, I would say. But right now, the trend seems to be international and domestic continuing to strengthen and commodities continuing to weaken in that third position.
So, Chris, that's really what you're telling me is really bull market stuff. Basically, we've got U.S. stocks, international stocks are doing well. And then commodities have been so strong, but now it's precious metals that have been weak. Oil's still been strong, but precious metals have been weak. So commodities are fading a little bit.
Yeah, I mean, oil's been strong, but it has seen a little bit of more injection of volatility the last, 2 to 3 weeks, and a lot of it's obviously based off of what's on in Iran. When there's peace talks, it tends to get hit pretty hard to the downside, and then if those peace talks start to break down, we see it kind of start to rally again. So long term, just because of supply constraints going on, things like that, with the war with Iran and everything, we expect it to still, be a strong asset class. But the volatility is really kind of week to week, playing with that asset class as a whole.
Mhm. Well, great. So, and then what about the other groups? Currency is not doing much. Cash, bonds, not really doing much at all. Bonds are still in the worst position of all.
Yeah, I mean, fixed income still continues. And, I think that could be a composition. I mean, I think right now, obviously, eyes are on inflation, things like that, whether the Federal Reserve is going to lower rates or continue to lower rates or raise rates. So there's a lot of, I think, potential out there to cause kind of issues. So that's why we're seeing, I believe, at least fixed income, even cash and currencies still kind of remain in the cellar down there because there's still this looming potential out there for inflation to come roaring back, for them to halt lowering interest rates, things like that.
Mhm. Very interesting. Okay, so we're in a bull market. And what about all the sectors? So what's working, what's not working?
So we still have energy. Obviously, if you guys have listened to the podcast for the last couple, got off to a rocketing start. This year it has come back a little bit, but it's still by far the leader. It's up 28.31% year to date, the energy sector. In the second place, we actually had industrials bump up into that second space from the third spot, and it's up 13.45%. Whereas materials moved down one, flipped with industrial, so it moved from two to three, and it's up 12.84%. So energy is by far obviously the leader. The two and three are pretty much tied. They've kind of been jostling back and forth. And then you kind of have this kind of secondary group here, and information technology is the biggest winner. So tech is in fourth position. It moved up 3 spots since the last podcast. Rocketed all the way up to be now up 10.40% year to date. So a huge move there from technology. Consumer staples is in fifth, and that's up 9.08%. And that actually was unchanged. Interesting. And real estate in sixth was unchanged, and was up 8.92% year to date. And then the last kind of in this group, the last one is utilities. And utilities kind of swapped with tech. So utilities moved down 3 spots. Tech moved up 3 spots. So utilities moved down three to the seventh position. And it's up 8.43% year to date. So you have kind
Mhm.
of this, these four positions in the middle here that are between, 8 to a little over 10% return wise. And then we have another big gap down. So these bottom four communication services in eighth, and that was unchanged, and that's only up 0.47% year to date. So pretty
Mhm.
big gap there. Consumer discretionary, that actually moved up 1 spot, and that's negative 0.12%, so relatively flat. Financials moved up 1 spot out of the seller there to the number 10 position, and it's negative 4.72% year to date. And then healthcare moved down 2 spots and now overtakes the last position there, and it's down 6.02% year to date. So kind of an interesting distribution. Obviously, we have energy at that top heavy mark. Industrials and materials have kind of separated a little bit.
Mhm.
They're kind of a separation of about 2 to 3% from the rest of the pack. And then we kind of have that pack of four there, that's still kind of competitive. And then the bottom four are really
Mhm.
flat to negative, negative 6% being the worst. So pretty wide distribution there.
Yeah. So, Chris, the thing that's striking to me about the numbers you just talked about is the difference between the top ranked sector and the worst ranked sector. It's as wide as I've ever seen it. Energy's up 28, and the worst is healthcare, right?
Hmm.
Down 6. You want to go through that list?
Yeah. So, I mean, energy, I mean, I think it's a really interesting market right now. And the reason we're seeing that big dispersion right now is, I mean, obviously, we're not operating in normal market conditions by any means. I mean, you have obviously the Russia-Ukraine war going on. You have the Iran conflict going on, which is causing havoc in the commodities markets all over the world. And then once you layer on top of that, I mean, several of these underlying issues we've talked at length about here on debt. So we have a lot of countries questioning the dollar. We have, China buying gold. We have a lot of these countries buying gold, which is propping up. So it is a very unique market than what we've seen probably ever
Hmm.
as far as these market conditions. And I can't remember a time really where we've had this much kind of geopolitical turbulence on top of kind of a already shaky underlying conditions there. So it's really interesting. And then I think the other kind of interesting fact with the whole thing is when you look at the US economy, a lot of people were expecting it to either fall off a cliff or really start to drag downwards, and it's held up relatively well. It
Hmm.
might be kind of slowly, moving down, but we're not seeing any kind of plummets or anything like that. And for the most part, it's held up decently well. So really interesting market right now.
Yeah. Well, in a few weeks ago, the tech stocks are still crashing. They're starting to rally now. We're getting a change there. And we were having a risk off market where consumer staples and conservative things were working better. Healthcare was better. Now healthcare is terrible. We're back to energy growing, industrials, information technology is rallying again. So we had like a 6 week shift, and now we're going back to bull market conditions, essentially, if you will.
Yep. Yeah, I mean, and we're kind of seeing that risk on appetite really rebound,
Mhm.
and that's playing out across almost a lot of asset classes. Bitcoin just topped almost coming up on 76,000 after it had a huge pullback. So we're
Hmm.
starting to see Bitcoin rally slightly again. And I think an interesting thing to note, the forward PE on the S&P 500 right now stands at 20.9. So that's the price times earnings, or price divided by earnings. That's above the 5-year average, which is 19.9, and the 10-year average, which is 18.9. So, you still have a lot of people willing to take that risk. And it seems like what's interesting is we had a lot of volatility spikes throughout the war, the kind of the initial phase of it. Now we're kind of in this kind of back and forth with the negotiations, and it seems like the market is starting to kind of tamp that volatility down a little bit. We're still seeing
Hmm.
it play out, definitely, especially within the commodities and oil markets. But the significant volatility spikes are getting a little bit more damped down, I think, as it goes on. So it seems like the market's
Hmm.
adapting to it a little bit more, and waiting to more or less digest the data instead of seeing these massive spikes one way or the other.
Brian Castle. I'm the CEO and founder of FourStar Wealth Advisors. Now, we built FourStar on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners, families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So, from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Well, Chris, if we're at 20 times forward earnings, we were at 23 times a record level. So now with the pullback that we've had because of the war, now we're seeing markets hit new highs, but we're still only at 20 times earnings. So that means the earnings have been strong. Earnings have come through strong, and we're expecting strong earnings for the second quarter as well. So the economy, it hasn't really recessed.
No, yeah, I mean, I think earnings have been a really one of the bright spots. I believe about 80% of the reported for kind of Q1, 80% of the earnings beat estimates, 80
Mhm.
plus. So they've been, I think, one of the other bright spots. Oh, here's my note on it. 88% beat earnings per share estimates.
Okay.
And blended earnings growth, they're tracking at 13.2% year over year. That's
Mhm.
the sixth consecutive quarter of double-digit earnings growth. So, yeah, that's been, kind of going back to my earlier statement, the US economy has actually been pretty strong. And I think that surprised a lot of economists.
Yeah. Well, so it's interesting. So the earnings can continue to grow. Market's not wildly overpriced. Um, so maybe we'll continue to have a bull market, Chris.
Yeah, I mean, I think, looking at that PE number, as you kind of pointed out, Brian, I mean, the trend is always for it to grow, and if the 5-year average is 19.9, if we're at 20.9, that's well within kind of the standard growth of earnings over that period, and kind of standard market fluctuations. So by no means are we I would say by no means are we in a bubble market where we're seeing like 40, 50, 60, at least on the broad market standards. We've talked about AI, things like that. There might be
Mhm.
individual industries, but we're not seeing a broad market kind of bubble. That's what that would say.
Yeah. Well, and as we've always said, there is sector rotation in a bull market, and we're seeing that in spades now because different groups and financials were one of the strongest groups last year, and they're in dead last this year.
Hmm. Yeah, I mean, the sector rotation is very important because if you just have a broad sector exposure, or you take a sector and just decide to ride with it, markets and the market assumptions and everything going on change drastically year to year. And I think that's a very poignant thing to say with this year especially. A lot of people, the expectation coming into this year was all right, we're going to see two, three, maybe interest rate cuts and the impact that would have. And right now they're more or less forecasting one cut for 2026. And obviously, with this Iran conflict and the impact that could have on inflation, that's going to put that under scrutiny as well. So, if you just look at even a year ago and kind of presumptions that were made, you pretty much have to throw those out the window at this point because we're in a drastically different world right now than we were even a year ago.
Yeah. Well, and for a while, the market was reacting to every statement and everything that happened in Iran for a couple weeks. Now it seems to be ignoring it. But what is going on over there? Are there more cause for concern?
Yeah, I mean, so we're on, they extended the ceasefire, so they're still having these negotiations, which I think is promising. I mean, I think personally, I think Trump is looking for a way, I don't say way out, but a way to resolve this. Um, so he's trying to kind of
Hmm.
push this and delay, if you will, as much as he can, but still wants to obviously keep at least some of a strict deadline, keep that hammer there, if you will.
Hmm.
Right now, I think what the U.S. did is it uh, is blocking, if you will, or kind of monitoring the
The
Strait of
straits.
yeah,
Yeah.
the Strait of Hormuz. And so what we're having right now is a kind of a cat and mouse game going on. So you have these what's been described as these kind of ghost fleets, if you will, that carry Iranian oil and Iranian products, things like that. That even going back 10 or 5 years were they weren't due to the some of the sanctions, things like that. They weren't allowed to, ship out. No one was allowed to buy it. They had this kind of fleet of what are ghost tankers, things like that, that would operate. They would change their names. They wouldn't have trackers on them. They would really try to, and so we're seeing this cat and mouse game happen. And to their point, maybe most of the U.S. Navy has really held up their side. They've caught almost all of them, or at least a large portion of them. So, right now, we're kind of really halting the Iranian economy, and we're putting a lot of a stranglehold on it right now, on their ports and everything like that. So, we'll see. I mean, I think there's a lot of, even though I think right now the U.S. is in a pretty strong position, I think they are in a tough spot. We would maybe have to put boots on the ground. I think it depends on what our overall objectives are. Obviously, there's been regime change at this point, but if our objective is to get rid of all potential for uranium enrichment, things like that, we're going to need to put boots on the ground. I mean, that's just a necessity. We can't do that from the air. So, um, ultimately, what does that resolution look like, and how do we kind of get there? I don't know. I don't know that answer. I don't know what Trump is
Hmm.
thinking. But that's kind of the crux of it right now is how can we get to that end goal? What does that end goal look like? And how can we kind of meet in whether it's a middle ground or something? I think right now the issue is Iran's positioning in the negotiation is extreme, extreme to one side. And the US, I mean, I think they obviously, if you're looking at it from the Iranian side, is their side's extreme, but a little bit more moderate. I mean, I think they want to be able
Hmm.
to enrich uranium. They want to be able to have no sanctions. They want,
Hmm.
they essentially want everything removed.
Hmm.
I don't think that's going to happen. And obviously, that's a negotiating tactic. But, if you have a list of 10 things and everything on that list of 10 things is pretty much something we couldn't do, it's going to be kind of hard to find middle ground. So we'll see. We'll see what the talks. Hopefully, the talks are
Hmm.
going well. I know they've stalled a little bit now, and there's been some back and forth. So
Well,
hopefully,
and it seems they're moving more and more assets over to the Persian Gulf
yep.
for the blockade, and so they could potentially go into Iraq, boots on the
Or
ground,
Iran.
like they said they wouldn't do, but they might, or in Iran, I'm sorry. And clearly those leaders are not the guys that they want to run this country. They're not saying that, but they clearly need different leadership because they were killing Americans and killing people all around the world and killing their own people as well. just to maintain control. So I think they're not saying regime change, but it seems to me that they're trying to get it. They've already killed so many of the leaders over there now, so that they're kind of causing regime change to some extent anyway. So we'll see. But it seems like the market right now is not living on every move. The market's playing an economic growth story right now.
Yep. Yeah, that
So,
the volatility from it has kind of definitely dampened down a little bit. At least so far. I mean, we don't know what's
yeah.
going to happen. I'm obviously when we do get, major news that breaks from it, there is some volatility, but it's nothing like we saw two
Hmm.
weeks ago, kind of at the
Right.
outset of it.
So let's turn to the economy. What is happening, Chris? I know you
Yep.
got some numbers on that.
Yeah, so I mean, I think since the last podcast, the biggest, news from the U.S. economic front is the Federal Reserve met. They held interest rates steady. Um, so they held it at 3.5 to 3.75%, and they penciled in just one cut for 2026 is the expectation now. So that was widely expected for the most part. So the market didn't really move too much off of that. But needless to say, I think most people were looking for that forecast as far as what they were expecting,
Mhm.
um, whether that would be one or two. Flipping over to inflation, March CPI surged 0.9% month over month. That's the largest monthly increase since June 2022, and that's a 3.3% increase year over year, which is the highest level since May of 2024. So we are starting to see a little bit of CPI increase. That was expected. I think in the last one, we only had the February numbers, which were still relatively muted. Um, this rose mostly because of energy. Energy was the main culprit. Energy was plus 10.9% month over month, with gasoline being up 21.2% month over month, and 18.9% year over year gasoline was. So obviously that was a big factor. When
Very
you
big.
look at the core CPI, which excludes food and energy, definitely much tamer. It was only up 0.2% month over month and 2.6% year over year. So that really does show, and that was an expectation. I mean, we knew that energy prices have obviously been risen. If anyone's filled up at a gas station lately, I know it's above $4 here in Illinois. I think California is above five, so definitely higher.
Yes.
That was pretty expected. February PCE, so this is the purchaser, the kind of the purchaser side, the front end of it. Price index rose 0.4% month over month, and 2.8% year over year. So that's actually a little bit more muted. But this is a February number where the biggest key is we have to wait for the March. That's going to be interesting. So some things to note: food prices were up 2.7% year over year. Airlines are and shipping carriers are layering on fuel surcharges. So in the April and May data, that's what a lot of economists are looking at. Are we going to start to see that flow through and really start to spike some of these numbers, even that core CPI a little bit more? So that's what we'll have to kind of see. But when we get those April numbers, we'll see how that sorts out. Switching over to consumer production, I think this is a little bit more of a bright spot. The S&P Global U.S. Manufacturing PMI held at 53.3 in March, and that was up from 51.6 in February. So
Mhm.
we continue to see solid expansion, in businesses, especially
Mhm.
with a lot of people front loading maybe with supply. They're expecting supply disruptions, things like that. But overall, manufacturing, consumer production's been strong. Industrial production declined just modestly in March. Consumer durables fell 3.4% year over year. Auto and vehicle parts were down 5.6% year over year. But business equipment was the one bright spot that was up 4%, 4.6%. So a little bit of mix there, but we're seeing overall some um, slight disturbances. Supplier delivery times worsened to their greatest extent in 3.5 years in March. A lot of
Mhm.
that, as we talked about, was just regarding kind of the conflict with Iran and the shipping challenges that they're running into there. And then manufacturing capacity utilization edged up quarter over quarter in Q1, but still remains below the Q3 2025 levels. So, you know, Overall, I think what this says is, consumer production is still, I think, holding its ground. There's
Hmm.
definitely some ebb and flow there, but for the most part, that's holding strong. Um, Consumer sentiment, total retail sales rose by 1.7% in March. That's following a 0.7% increase in February. The biggest reading into that is gasoline was the primary driver, because it's retail sales. So if gas is more expensive, kind of drives that number up. If you had just excluded gasoline sales, that number was only up 0.6%, so pretty much in line with the previous month. University of Michigan Consumer Sentiment Index plunged to a record low of 47.6 in April, which is this month of 2026. The all-time high, just for looking at the opposite end, was 112, and that was in January 2000. Uh, so,
Wow.
um, so consumer sentiment overall, I think, has been obviously waning. I think a lot of people are concerned with the gas prices, some of the geopolitical uncertainty, things like that that we have been experiencing the last couple months.
Mhm.
The housing market, March existing home sales fell 3.6% to 3.98 million units, and that's on an annualized rate. And that's down from 4.13 in February. Not a huge move, and I think most of that was just attributed to mortgage rate volatility with the Iran conflict. March marked the 33rd or 30, yeah, 33rd consecutive month of year-over-year home price increases. So the median existing home price rose 408,000 to 408,800. That's up 1.4% from March 2025 and a record high for that month. So we continue to see, interestingly enough, we haven't seen kind of a break in the housing market as far as home prices continuing to rise. We continue to see that slowly move up. Total home sales of 1.36 million units, or total homes for sale were 1.36 million units at the end of March. That was up 3% from February. Um, so we're starting to see more homes come on the market, which is good, and that's promising.
Hmm.
Um, Switching over real quick to the job market. This is the last of the U.S. Jobs or the March non-farm payrolls added 178,000 jobs, with the gains concentrated in healthcare, construction, and transportation. The unemployment rate came in at 4.3% in March. That was pretty much flat month to month. And labor participation rate held at 61.9%. So, what's really interesting is if you guys remember, we saw the previous non-farm payrolls was a big miss to the downturn. And so we saw a big rebound back in March, which was overall, I think, a shock. A lot of economists were shocked, and that was overall promising for the jobs market there. So, overall, I think the jobs market has held. I don't think we're seeing a massive amount of expansion, but I think we're seeing
Hmm.
at least kind of a holding of the line, if you will,
Sure.
in that front. So,
It's interesting. Well, go ahead.
yeah, that's what I have from the U.S. economy. I don't know if you want to add anything, Brian, there, or I'll switch on over to the international markets and the thing I see there.
Well, and we're seeing record refunds from U.S. taxes coming out now. I think it's $180 billion is going to be in consumer hands over the next couple of months when they file their taxes. And when the administration, I think, because this is a political year, had hoped that that would help consumer sentiment, and so far it hasn't. And the president's poll numbers are getting weaker and weaker. The rigors of this war and the concerns with gas prices and everything are hurting the leadership and the current majority in Congress. So we'll see. Now that could change pretty quickly, and a lot of folks are saying, well, it's a sure thing that the current leadership team is going to switch from the Republicans to the Democrats, and it's going to change. Trump's going to get impeached again, and all those things that would happen if the Democrats were in charge. So, but we'll see. People aren't going to make up their mind until probably around September or October what they're going to do. And a lot can change between now and then. This war situation, maybe things get better. The economy is strong enough. I saw Microsoft just announced 7% of their people were offered a buyout. So AI is reducing some employment, but the jobs numbers weren't bad either. So, it's very possible the economy gets stronger and then sentiment returns. So anyway, Chris, what do you have on the job market?
So, I mean, the job market, as I kind of had mentioned before, overall has held pretty steady. I think one caveat kind of to add on to what you were saying, Brian, is I think what I'd be interested in, this is more of a long-term statistic that we look at, but I think will AI impact productivity rate? So what that means is we could have potentially our GDP, gross domestic product, remain the same, if not grow, with lower unemployment. So, the average employee is producing more, per person. So, I'll be interested to see, if we do see AI really interject itself into a lot of industries in the way that people are expecting, we would expect to see productivity increase quite rapidly. And it's been really interesting because that's been one of the kind of statistics that has really held flat. We really haven't seen it move in the last, 20 some years. So that'll be an interesting note there. So, but flipping over to the international markets, China's Q1
Good.
2026 GDP grew up 5% year over year. And that was
Mhm.
actually at the top end of their target. And that accelerated from the Q4 reading of 4.5%. So seems like, I mean, once again, as we always say on here, you got to take anything out of China with a grain of salt. But it's kind of hard to fake GDP to a degree. There's a lot of people that can also read into those numbers as far as what they're producing, what they're pushing out. So it seems like they're overall growing slightly from this, at least so far in 2026. In Hungary, Prime Minister Viktor Orban conceded defeat earlier in the month. So the opposition uh, secured a landslide election win there, and that was a significant political shift in Eastern Europe. So that'll be interesting. Obviously, we still have the Russia-Ukraine conflict. There's a lot of potential dominoes that could fall over there. So just things to keep on the lookout for. And then the dollar index weakened to the 98 range. That was the biggest weekly drop since mid-January. Continue to see the dollar weaken. Most of that probably is over maybe expectations of rates being cut more. I know we have a new potential Fed chair, and there's a lot of
Mhm.
thoughts that he might be tempted to lower rates more just to, shore up the economy. So that's something that is also in play right now and is affecting the markets.
Well, and the big story for the last year or so has been commodities, which have been very strong, Chris. And, we had a huge rally in gold. Gold went to new highs. Then we had silver moving, platinum, all the other palladium, all the other precious metals moving. That's since faded. Where are we on commodities?
Yeah, so keeping on that gold idea, so gold has actually posted four consecutive weekly gains coming into this week. So that's obviously promising. It's now trading near $4,847 an ounce.
Okay.
That's after hitting an all-time high of 5,900 or $5,595, and that was on January 29th. So
Mhm.
pullback there, but we've mentioned this before. That's natural. I mean, gold had I mean, we were talking, I remember just a couple of years ago, gold at 2000 is going to be able to break above 2000. Now we're talking gold, 5,500. And, as far as some major firms are their year-end targets are still at 5,200. Gold continues to be, I think, a strong asset class as a whole. It's not, immune from volatility. So you will see this go through, especially when you have growth like that. But overall, I think the bottom, the push case for it that's happening is slowly moving it back up now, which is good to see. And then oil's been the other big one. So I mean, this oil's been getting whipsawed. I mean, it's we saw oil fall 10+% on ceasefire news. We've seen it surge 6 to 7% off of renewed tension. So we're really seeing it just kind of whipsaw back and forth off of news. Right now, it's still sitting between really that $88 to a little over $100 a barrel. It's kind of where the niche is at. So we'll see if that changes. It's probably not going to change unless we
Hmm.
get any more immediate news.
Hmm.
But while that's going on, the national average gasoline price is now above $4 a gallon. That's the first time we've seen that since 2022.
Hmm.
So we'll see if that, that the impact that's going to have on the bottom line and gas prices especially, it's a tax essentially, right? I mean, if you have
Hmm.
to drive a car, if you have to do all that, you're going to have to pay for that. And not only that, it's built into all the goods that you consume. So,
Well,
uh,
and people, Chris, should keep this oil move in perspective. And for those who were around in the 1970s, West Texas Intermediate crude was about $3 a barrel back then. But because of OPEC and the collusion of the oil producing exporting countries, OPEC, they were able to push oil prices up to $18 a barrel. So that's a six-fold increase. That'd be the equivalent of going from 75 or $80 a barrel up to $500 to $600 a barrel. Can you imagine what the economy would do if we did that?
mhm.
Obviously that totally tanked the economy. That also created the worst stock market in American history, or at least in recorded history. Even worse than the Depression market. The market was down over 70% from top to bottom in the 1970s, from like 73 down to 1975. Because it totally killed the economy back in the 70s. I was a young teenager back then, so didn't have the same impact on me personally, but our parents had to deal with it and all the Americans at that time. Um, so it's really an interesting situation, but it's all, the oil situation going on right now. But let's keep it in perspective. It wasn't near as bad or hasn't been near as bad in the last couple of months as it was back in the 1970s. And so that's why we're not seeing such an economic impact. And with all that money coming back from the government for tax refunds, and the economy has generally been okay, we could see an economic boom here.
Yeah, I mean, I think a lot of it will be dictated over the next couple months. I mean, I think where you see the devil's advocate to that is, oh, well, a lot of the what's it called? A lot of the tax returns going to get eaten up by gas prices, things like that, and we're going to see reduced spending. But we really don't know. We could have a ceasefire, the next week. We could have a resolution that is, acceptable to the American public in the next week or 2 weeks, and that would change literally everything drastically. So there's a lot that remains to be seen out there, I think. I think right now, as we've kind of highlighted, overall, the U.S. economy is holding up pretty well. We're not seeing an explosion of growth, things like that. Earnings have been good. The jobs market's holding steady. Some of our production is, for the most part, holding steady. So there's a lot of promising things, I think, that are still there.
Mhm.
But the market's going to be dictated in many ways by what's going on in the Iran conflict. So we'll have to see.
Absolutely. Well, good. I think that's all we have on the economy. What do we see out there in general in the world, Chris, that is worth noting for all our listeners here?
Yeah, so Apple named a new CEO, John Ternus. So that is Tim Cook has signaled his plan to departure, I believe, in the fall. So that's big news. I think during Tim Cook's tenure at Apple, I think their stock was up like 1,200%, which was pretty crazy. So
Yeah.
overall, the markets. Apple's been down slightly, but we're not seeing a huge move downwards from the news, so it's taken it relatively well. Meta Platforms announced the first round of its planned layoffs. They're laying off approximately 8,000 jobs. This follows their earlier announcement that they're reducing their global workforce by roughly 20%. So continue to see that trend really in the technology space, especially. A lot of those large tech firms are kind of slimming down their workforce. Top
Hmm.
Build surged 19% earlier this week on news. It would be acquired by QXO for 17 billion in an all-stock deal. So we're
Hmm.
continuing to see some M&A and consolidation within the U.S. building product sector. So we're seeing them try to scale there, maybe get ahead of tariffs, maybe bring prices down slightly, make it more competitive. OpenAI, the big AI firm, surpassed 25 billion in annualized revenue.
Hmm.
And we're seeing them take their early steps towards a potential IPO in potentially late 2026. So that would be huge. And the next thing is SpaceX, which is another IPO. So this might be a huge, a record-breaking in many ways year for IPOs because both OpenAI and SpaceX are going to be monster IPOs. SpaceX acquired xAI, that's Elon Musk's AI company. And so this is
Okay.
important. It deepens the integration between Musk's ventures. Um, and the last thing I'll mention, Live Nation Entertainment is found to have an illegal monopoly in over the ticketing
Yes.
market, and this was found by a New York federal jury. 34 states were party to the suit, we'll see. Maybe we're going to see some lower concert ticket prices coming down the line, hopefully.
They definitely were colluding in a way that kept prices high. It's $300-400 to go see a concert anymore these days, a good concert at least. Um, Well, and one of the consequences, Chris, to this gasoline and fuel issue is the airline industry is struggling big time. They are estimating to lose over $22 billion as an industry. And all the companies are losing money right now because of fuel costs. Spirit Airlines is possibly going to shut down. Their merger with JetBlue was turned down, which was a lifeline for them, and they're looking for relief from the federal government. They're trying to get President Trump to help them out. We'll see. They may let Spirit Airlines go out. That is kind of the nature of how capitalism works, unfortunately, but we'll see what they do. Although ironically, even though all that's happening and consumers are paying more for airline flights, 64% of folks say they're comfortable right now with the economy due to wage growth. There's been wage growth in the economy. It was very negative under the previous administration. So we're seeing, again, the signs of a decent economy. Europe is in much worse shape economy-wise on the fuel issue because their fuel prices are always higher and they import everything. America is still now the largest producer of energy. And now with President Trump working on Venezuela and in control essentially of the Iranian markets by blocking the Straits of Hormuz, he's obviously in charge of the oil in the world, it seems. It's actually affecting China and Russia and all the other countries. Eventually this will get solved. But it doesn't affect America as much because we're a producer of oil, the biggest producer that there is. It does definitely affect other countries. China gets 90% of their oil from the Middle East, and that's affecting them big time. And Europe obviously is not in great shape either. Um, Chris, we also, moving just to what's going on out there a little bit further, we completed the Artemis 2 trip up in space. Four astronauts went the furthest away from the Earth ever. I met the captain of Apollo 13 a couple of years ago before he passed, Jim Lovell. And Jim talked about how they were on the far side of the moon. And I always said Pink Floyd called it the dark side of the moon. And he had a little debate about that. But, Artemis actually went a little bit further than Apollo 13 did. So we're back to space, Chris. It's kind of exciting stuff and all the things we're going to learn from space. So that's an exciting development for the American space markets. It's a space race again against Russia, which has always been trying to beat us in that world, and China as well now. Baseball season is coming on. Playoff hockey is happening. There's a lot happening. The federal government actually did pass some bills to fund the Department of Homeland Security. That's been a contention between the two parties. And the one party, the Democrats, are blocking that. Looks like they're probably going to get a bill through. So that's a positive development, I think, because we really cannot be without our security. and having all those people paid, and then protect America. So we need to fund Homeland Security, and that's happening now as well. So those are just some of the other things that are going on in the world. Now that we've seen a big pullback in the markets, Chris. We're looking at how do we protect our investors? And as we mentioned in previous episodes, the FourStar protection plan has come into being again. We started raising cash about 2.5 months ago. We went to position number two. We got some signals to possibly go to position number three, but then it turned around right away. There are four positions to go to maximum cash. The last time we have done that to protect the accounts was a week before President Trump's Liberation Day last year on April 2nd. So we were already in protection before the market collapsed that time. It doesn't appear like the market's collapsing anymore. We're in kind of a trading range. So we may not go to full protection, but we are in protection mode right now. And it's been a help to our investors where the markets were down. S&P was down 4% for the first quarter. And most of our portfolios were up because we raised cash and avoided some of that pullback from the highs when the S&P went negative for the first quarter. So that's where we are right now, folks. We are in protection mode, position number two. Right now, we're not getting any additional signals to go to position three or four. So we might stay here and turn around and go back up and get more fully invested. And it appears that looks like the trend, but it could go the other way at any time. We watch it very, very closely. So that's where we are. So that's what we're doing about all this, folks. Markets do what they're going to do. 85% of the time, they're going up in a normal fashion. But 15% of the time, we're either in correction or outright panic, as I like to say. And we've been in correction mode in the markets, but still no recession yet. So we'll see if it gets much worse. And if it's time to really prosper and we're going to hit new highs again in the market, we're probably going to get back in. There are some interesting blog posts for everybody. If you look at the leadership matrix at fourstarwealth.com, there's a lot of interesting articles that we post, so have a look at that. There's real estate discussions. There's a whole series of other things about international investing as well. So have a look at the leadership matrix at fourstarwealth.com. Chris, what else do we have today? Anything?
No, that covers it for the middle to late April, I guess.
There we are. Good. The weather's getting better in the upper Midwest and our headquarters in Chicago, so everybody feels better. The economy seems to be holding in there. So let's make it a good month here. We'll next check in with you in early May, and we'll see how things look then. Thanks for being with us, everybody, here on today's Market Explained. And I guess that's it for us today, Chris.
Yep. Take care, everyone.
Thanks, everybody. Over and out. Make it a great couple weeks. We'll talk to you in May. Bye-bye now.